Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, March 27, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And we had a reversal of the reversal from yesterday. So yesterday, I was reluctant to call it a reversal day. We talked about it in the video last night. And I said that based on the fact that the down volume from the day before was higher than the up volume from yesterday, that was my primary reason why I didn't necessarily want to classify yesterday's up move, albeit a tremendous up move, but I didn't want to classify it as a reversal day. And then we identified a couple of levels. The first one was 266.50. And then there was one above that if we should begin closing above that level at 269.25, which came right above the 100 period moving average, right below the downsloping 20 period moving average, which is the red trend line. So we identified the first level at 266.50. You can see here that the high of the day today was 266.77. And when you go down to an intraday chart, you can see what happened. The market consolidated right underneath that level for a portion of the morning session. So here's the 940 candle. So the first candle of the day, we made an attempt at that level. We sold off a little bit, but we consolidated above the moving averages and made an attempt at that level. Now the consolidation would normally mean that we were consolidating to actually go higher than that level because we consolidated right below that level. Under normal market conditions, that's generally what this consolidation phase was telling me, or it was telling me at the time. However, when we traded up into that level, we immediately failed. Within half an hour, the market was failing. We made a bearish wedge pattern, made one more retest of that level. You can see here the high of this candle was what? 266.50 on the button. The market was rejected and we sold off for the remainder of the trading day. Now, why is this important? It's important for a couple of reasons. Number one is the levels are the levels. Let me point out why this level was important. And this is something that's right out of my course at LazyEMiniTrader.com. So if you take this pivot high here and you take the pivot low from the other day, okay, this was a normal garden variety retracement. I go over exactly how that's calculated in the course at Lazy E-Mini Trader. But the other reason why, and when you have more than one reason why a specific price level is important, that adds more credence to that price level. So what I did is I look to the left and I say, well, look at all this consolidation right around that spot. So whether or not it's 266.40, 266.50, 266.70, doesn't really matter. It's the general area right in here that told me that that level that corresponds with the retracement was important. You also have, here's where the market found some support and rallied off. Now, obviously, we spiked through that particular number here, but you can see that this level is important. Here's a couple of more pivot tops that were made. And then what happened is you can see here that even on a micro scale, when you take it day by day, you can see here, the market stopped right here. The market consolidated right here. The market stopped right here on the downside, consolidated right over that level. Again, retested it right here, and then we took off to the upside, okay? All this activity on the chart tells me that the past is telling me that that price level is important. And when I have more than one reason, namely 2 or 3 or even more, that when the chart tells me that that price level is important, you want to pay attention to it, and it generally has a lot of significance, and you can't ignore it. The other thing, and I think it's important to reiterate this, we talked about this last night. So the market was down, quote unquote, on the news event of the fact that we're potentially entering a trade war with China. That news broke last week. The media rode that horse all the way while they rode the market down. Then, all of a sudden, the Treasury Secretary, Steve Mnuchin, comes on TV. He was marched out on the Sunday talk shows, and he was basically sent out to calm the markets. So he said it's a long-term process, good for America, this, that, and the other thing. That's a script. He's supposed to say stuff like that. That's generally how the government works. For example, the press secretary of whoever the president is, whether it's President Obama, President Bush, President Clinton, President Trump, it doesn't make any difference. The press secretary, that job, whether it's a he or she, their job is to put the administration and the president in the most positive light that they can. So they're basically spin doctors. Same thing with every other job in and around throughout the administration. They're never going to come out and say, hey, by the way, just wanted to let you know this is bad news, so you better watch out. They're always going to try and spin it to what's positive for the American people, positive for the country. Whether it is or not, that's always going to be their story. So when the market went up yesterday, it was basically the media was riding the market up on the fact that, well, the trade issue isn't as bad as we thought it was and blah, 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 blah. And you know the story. So that's the way the market works. It's not really trading on the news. And I've done this before and I'm going to do it again. It's a small soapbox. Basically what happens is the market picks a direction. The market's going up, the market's going down. If the market's going up, the media looks for a piece of news and that becomes the reason why the market's going up. So it's not that the news drives the market, it's the market driving what news event they want to put in the forefront of whatever the media is reporting. I understand and accept the fact that a lot of people have a hard time wrapping their head around that type of concept. It's generally the opposite of what we are really programmed to think. But if you've been around my videos long enough, been around me long enough to understand that the market is going to trade based on what the charts are telling us. It trades based on what the technical chart setups are. It trades based on what the cycles are telling us. Right now, we're in a down cycle. Right now, on the daily chart, this is a market that's in a downtrend until it's not. Okay, we're below all the moving averages. We're now starting to make a bearish pattern at the lower end of the chart. We've tested the 200 period moving average a couple of times. It's a couple of times on the cash market. It's actually one more time on the futures market. I showed you this the other day. I'll show it again. See, here's a test of the 200. Here's a test of the 200. What we're looking at here is the S&P E-mini futures contract. Here's a test of the 200 last week, and we're hovering above that level. The likelihood of this holding as it stands right now, anything can happen, but the probabilities of the 200 period moving average holding right now are basically slim to none. It can happen, it's just not probable that it will happen. One daily chart close below the 200 period moving average, and the likely story is we're going to make new lows. Now, we're back on the spider chart. I want to make mention of something else, and it's interesting, and I enjoy the interaction. I like when you folks comment on the videos. I'm going to answer each and every comment, whether it's directly on the video or you send me a direct email. Either way, I'm fine with it. I like the interaction. I like the conversation about the markets. I like when you guys are learning, and guys is a generic term. I know there's gals out there. No offense, please. The more you learn, the more it's going to benefit you over time. It's just that simple. But yesterday, I had a trader comment that it seemed like I had a bias to the downside, and I'm guessing that that particular individual is long the market, so maybe getting a little frustrated that the market on a big up day like yesterday, where I wasn't necessarily saying there's a lot more upside coming. We've found a bottom. We bounced off once again the 200 period moving average. That's basically what the trader was saying, and it seemed to me he was getting a little frustrated that it seemed to him that I had a bearish bias to the market. And I don't have a bias to the market. The only bias I have is what the charts are telling me. I don't care whether the market's in an uptrend or a downtrend, as long as I'm able to identify what the trend is and how to financially benefit from that trend. That's all I really care about. So if we turn up and all of a sudden we're above the moving averages, for example, let's say 2 or 3 days from now, we're trading up here. I'm going to say the market is back in a bullish stance. That's fine. Or let's say we go down to this area, put in a signal of a trend change, something that's discussed in my course at Lazy E-mini Trader. Let's just say that we go down to this 250, maybe it's 248, maybe it's 246. Wherever we end up finding a bottom, whether it's 250 or below or above, and we find a signal of a trend change, the market tells us that it's bottoming out, we see a reversal at hand. you're going to hear me get very bullish very quickly, because that's where the money will be able to be made in the market when the market is bottoming, because a rising tide will lift all boats. And if we're able to pick the bottom correctly, you're going to see stocks rally 8, 10, 15, 20, 22, 25% in a matter of days from a very oversold condition. Just the same, any trader, and we'll go back to, we'll go to an hourly chart this time, any trader that sold the market this morning up in this area saying, well, that's a resistance point, let me take a short position in the market, and I know where I'm wrong, because if we begin closing hourly above this level right here, then I have to move out of the position, right? So we had a very, very small risk on a short position this morning on a pierce through 266.50 or at 266.50. If we closed any hour following the hour that we hit 266.50 and closed above that candle high, then we're out of the trade, because the market will have basically an upside bias for the short term. So it's basically, and what I like to say is, you're very close to risk at that point. Anybody that sold the market up there is sitting in the catbird seat right now with huge gains in a market that's in a downtrend. And this is worth another look. Let me go back to the daily chart, and let's just say, for argument's sake, that the market comes down to around the 250 area. Maybe it's down below, maybe it's slightly above, but we identify the fact that the market puts in a signal of a trend change. We have an intraday reversal in this hypothetical example, and we begin to buy the market. Whether or not we buy individual stocks, or we buy the S&P, we buy the NASDAQ, we buy the IWM, we buy the Dow via the DIA, whatever it is, you know, a rising tide is going to lift all boats. So markets are generally all going to go down together, not to the same magnitude, but when they bottom, they're all going to rise together as well. So let's just say we identify a signal of a trend change down in this area, somewhere in this neighborhood. Maybe it's lower, maybe it's not, but it doesn't matter. We're going to wait until we see the signal occur. And this is so important, and this is taught in my course at Lazy E-mini Trader. What happens is, we're able to identify where we're wrong in the trade. So for example, let's say we think the market bottomed, we jump in a couple of equities, we jump into the spiders, whatever it is. Then all of a sudden the market continues lower, and it closes a couple of days later below the day or below the low of the day where we thought the low was in. Well, we move out of the trade. At least we took some risk, we were close to risk, but we're never going to let a trade turn into a big loser. Identifying the actual price, the area, and the reason why you're wrong is ultra important in trading and investing. The biggest mistake that traders and investors make is they take a position and they're wrong, and they end up trading on hopium, figuring it's going to turn around and they'll be okay, and then it gets worse and worse and worse, and they end up typically selling out at the bottom. Based on what? Based on emotions that they can't take it anymore. And what happens is, once you sell, when you're in a position that's losing a lot of money, it's very, very uncomfortable. We've all done it. We've all been there. In this business, I can attest, you learn from your mistakes. But here's what happens. Once you get to that maximum capitulation point where you actually unload the position, you cut it loose, you cut and run, you sell out, you actually feel better about it. Even though you just booked a big loss, you actually feel better because the pain is over. There's no more loss in that position. You can't lose another dollar in that position. Your loss is defined, it's booked, it's over. So you actually get a sense of relief. That's the emotional side of trading. And then what happens about 8 out of 10 times, whatever you were trading in, the stock, the option, the index, turns around almost immediately and heads in the direction you thought it was going to go, or hoping it was going to go anyway, and now you're out of the position and you watch it go without you. That happens over and over and over again. I know, I get it. It's emotional. That's the emotional side of trading, and that's how the market really takes a lot of traders and investors out behind the woodshed over and over and over again. Its job and its design is to make you do the wrong thing at the wrong time. That's why we need to learn how to read the charts correctly so you can do the right thing at the right time. All right, back to the markets. Basically, the market has turned back down. We basically wiped out, for the most part, yesterday's gain. We're not back to Friday's levels right now, but certainly we have to take a cue from how the market closed today. Remember, it's not necessarily how they trade them throughout the day, but it's how they close them. And while we did bounce off the lows at the end of the day, this is the hourly chart, you can see here that we rolled over in the afternoon, and there's really not a lot good showing up on the charts right now. The chart is saying that this is bearish, this is in a downtrend, and it is my take, and this is what the chart is telling me, that the market wants to go lower. I've still got my eyes set on the 250.32 area in the SPY. Let's go over to the IWM. So the IWM, same deal. We finished basically very close to the lows from Friday. Again, bearish chart. This is headed lower. We will find some support in this general area here. Intraday, we may make it down to the 200 period moving average. However, the longer we consolidate over and above this area, for example, if we begin to edge lower, then this is going to become less important. The 146.95 may actually have to get moved down, and we actually may come down all the way to this level, down a double bottom. I'm not ready to say that in the IWM just yet. I need a couple of more days of activity, see how the market treats this low here, to see whether we come down in a straight shot with a lot of velocity very quickly. That's one thing. But if we hover over this area and consolidate around this general zone, then the market's telling us that it wants to go lower. IWM down 2% today, $3, very bearish, leading the markets lower. Now it was down not that much more, but slightly more than the spider, but certainly when the IWM is down and the transports are down, which we're going to get to in a minute, you have to look at the market and say the underneath the hood stuff of the market is telling us that the market is weak and wants to head lower. Speaking of the transports, you can see here we were down almost 2% today, along with the spider and the IWM, 1.85%, 191 points. And you can see the charts look very similar. We're underneath the 120 and 50 period moving average. When that's the case, the market is in a downtrend, and it's in a downtrend on the daily chart, hovering over the 200 period moving average. What this tells us is, and it's the same story, again, all the charts act and react the same way. Doesn't really matter what the name of it is. Doesn't matter whether I'm looking at the transports or some other chart. But the fact that we're hovering above the 200, and if that continues, that's going to lessen the impact of the 200, and it's going to tell us that the market wants to trade lower, and the likely support area, at least initially, will be down here at double bottom. I don't even know that we stop at double bottom. It depends on how long we consolidate. If we consolidate over this area, if we have another few days like this, or if we begin to edge lower instead of coming lower with a lot of velocity, then that's going to diminish the importance of the 200 and this double bottom. We'll have to see what happens in the transports, but all markets are basically trading in sync right now. Just to get a bird's eye view of a longer time frame, looking at the weekly chart of the transports, you can see here it's pretty clear, and this is something I discuss very often. This is a bearish pattern. You can call it a bear flag pattern. You can call it a bearish wedge pattern. I don't care what you call it. It's a bearish pattern, and this will likely result in another move to the downside. Now, if you believe in market symmetry like I do, this pattern right here is telling us that we can get all the way down to around this double bottom here, somewhere in that neighborhood. Maybe not that quite that far, but even if it's down here, okay, we have a long way to go. Whether or not we get to the weekly 100 period moving average, we'll see. But we certainly have, if this bearish pattern plays out and market symmetry means something, okay, that's going to put this market all the way down in this zone somewhere down here. That puts us down right around 9150, 9250, 9300, somewhere in that neighborhood. This pivot low happens to come in at 9420. We'll see if that's able to hold, but that's a long way off from where we are now. That's another 700 points away roughly from where we are right now. What I will tell you is, from a weekly chart perspective, closing any week on a Friday close below this level right here will be very bearish for the transports. We can trade there intra-week, but if we close a week below that level, that's going to be bearish. And this is your safety net right down here. So there's two levels. Well, this is very important for us to hold this general area on a weekly chart close. If we close below those levels, you do have the 100 period moving average. However, the market will be susceptible to lower prices. Okay, switching over to the gold market. We had a slight down day today in the gold market, down about 10 bucks. However, as long as we stay now, this is where we are today as far as I'm concerned, as long as we stay above this green candle low, this market can consolidate for a while, and it should need to consolidate in order to build energy to make another push higher. Okay, the market got a little bit overbought very quickly by a couple of large up moves or a up move for a couple of days, so the market gets overbought real quick. So just the other day, we were all the way down here at 13.15, give or take, and next scene shows we're up here at 13.65 and change, 13, up in this neighborhood. So what happens is the market just needs time. It needs to work off some of the short-term overbought condition that developed, and that in order to do that, the market will generally work its way sideways. We got a little bit far away from home base. Let home base edge up to price. Let price come back toward home base, and then it can reset and build energy for another push higher. That's what I see happening in gold. We close below the green candle low that comes in at 13.34.80, and something else is going on, and then the bullish case, at least temporarily, would be off the table. Crude oil had another down day, being dragged, in my opinion, down by the markets a little bit, but this is nothing wrong with crude oil right here. We're hovering around the $64, $65 area. We made an important move over the last week or so. And again, same discussion that we just had in in gold, is crude oil just needs to work off some of the overbought condition, let the 20 period moving average slope up toward price, let price come down toward home base a little bit, let it consolidate, go sideways, eat some time off the clock, build some energy for another push higher. That's the way I see it happening in crude oil. It's really the same thing we just discussed in the gold market. And there it goes to show you, all charts act and react the same way. They don't always all look the same, but they all act and react the same way. And basically, folks, that's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.